The Money Show. Personal finance.
So we got a letter. We get lots of letters. We get emails from people who say, can you solve our problem for us? And there's some crazy ideas, and we can't get to everything, but there's some fairly sensible ideas and some really good questions. We got a letter from John, who wants to know about endowments and cashing those in. He goes, "Hi, Money Show. I was wondering if anybody had done a simplistic analysis as follows. Start in mid-60s, investing 50 Rand per month in a Liberty endowment type vehicle and increasing each year by CPI. So that begins to add up quite quickly over time, versus spending 50 Rand per month on Liberty shares and increasing annually by CPI. So buying a Liberty endowment or buying a Liberty share, which has earned you more money over time. Just wondered which would work out to have the best return. Regards, John." So we set the task to Warren Ingram.
And of course, being me, I tweaked it a bit because the timeframes are so far back that, to go from 1960 to now, things like the data on the JSEs changed dramatically. And so it's quite difficult actually to do that. So what I did rather was to say, well, what happens if we start with 1,000 Rand and we put it into, and I didn't want to single out Liberty. I think that's unfair. So I said, well, let's put it into Liberty shares, Discovery shares, the all share index, and then a typical endowment. And I'll explain what that means now. And then let's compare what they do over 1 year, 3 years, 5 years, and 10 years. And so what is a typical endowment? If I look at the costs of an endowment over a long period of time, and we've done it across a range of different insurance companies, all of them.
Well, before you talk about the costs of an endowment, what is an endowment? It's an investment product.
It's an investment product, and typically they are sold on the basis that if you buy them, you need to leave the money invested for a period of 5 years as a minimum. You can definitely go longer, but you shouldn't go less. If you hold the endowment for 5 years, what happens is when you take the money out after that 5 year period, it becomes tax-free for you, the investor. That doesn't mean that there's no tax whatsoever, but it gets paid inside the endowment by the insurance company on your behalf, and so you go. And so a lot of the time, especially in the old days, so if we go back to the 60s, endowments were really popular because what they would do is they would sell them to young parents as education policies. They'd say to you, your child's going to start, high school or varsity, whatever the deal is. Let's start an endowment, and then, it's a 5-year or a 15-year deal, depending on how old the child is, and you get the money paid to you at the end of that time. And that still gets done today. But that's typically the basis for an endowment. And so they're still very popular. And I think that tax-free angle is what attracts a lot of people nowadays. And so they make this decision. Let's put the money in the endowment and let's see how we go. Now, when I look at the costs of endowment, of course, insurance companies don't like to make it easy to understand the costs of these investments. So it takes us quite a bit of work to actually understand them. And I think it averages at about 3.3% per year is the cost that you pay when you look at your administration costs, your investment costs, your insurance agents costs, all of those things. If you look at that as a typical cost, I think 3.3 is the number. But I wanted to be a little bit careful here. So what I said was, let's look at the all share index, but we don't take off 3.3. We take off 2.5% a year costs. Just let's undershoot a little bit, to make sure that we don't get accused of bias by anybody in our arguments. And then I said, okay, so let's do it. Let's put 1,000 Rand into each of these and see what happens. And so just not to throw numbers, because we can get death by PowerPoint or death by numbers. Let's look at 10 years, because I think that's a fair term for someone who would want to make an investment. If anybody's looking at, like a long-term investment, we'd always say to them, 5 to 10 years is a good number. So I think 10 years is fair. So after the 10-year period, should we start in ascending or descending order?
You do what you feel is right.
Okay, thank you. I like that. It's the first time you've ever let me do that. So let's start at the top. Over 10 years, your best performing investment would have been the Discovery share. So not the product, but Discovery, the share. Your 1,000 Rand after 10 years would be 4,689 SA Rands.
Okay.
I'll come back to tax now because I think that's an important thing, but that's it, 4,689. Then your second best performer would be Liberty Holdings, 3,064 Rand. And then third is the All Share Index, 2,885 Rand. And the last in the ranking, the worst performer then is the typical endowment, 2,164 Rand. Now, the tax argument is important here because, you would say, well, hang on, you get your 2,164 Rand after tax on the endowment. So what I did was I looked at what's the maximum capital gains tax that an investor would pay. So if you're paying 45% tax, you're you're earning millions in a year, and so you're going to pay the most tax. And we say, well, let's just and that will just for explanation, that's 18% is the maximum tax, but then I just topped it up to 20%. So if you pay away after the 10-year period from the best performing investment, you pay away tax, you're going to end up with 3,751 Rand. So it becomes kind of clear and obvious to me. It's a little bit painful to me because, I like to talk about index investing.
But that's a 60% outperformance.
It is. And, I mean, the two individual shares have smashed the all-share index, which is also a bit problematic for me. It doesn't suit my argument of, you should always just buy the index and be done with it.
But I could have given you Steinhoff, and I could have given you another one of my S shares, Steinhoff. Sasol.
MTN.
I could have given you underperforming shares. I mean, the fact is that you chose Discovery, which is in a rapid growth business. It surprises me that Liberty's performed that well, actually, as a share, because at one point they were on their knees. They were really struggling, but they've had a big turnaround.
Well, and also that's why I wanted to choose Discovery, because it is a growth share, but over the last year or two, it hasn't had a great time. So if you just look at Discovery over the last 12 months, it's lost 22% of its value. So we're talking about, if we'd done this kind of to the end of 2017, this would have looked very different in Discovery's favor anyway, even better. So just a very interesting, observation here. So, because what happens after this show, whenever we name anybody, we get abuse. And so just to point that out, I mean, if you'd asked me, I would have bet you the index would have been close to the top of the pops, and then the shares somewhere around there. And I would have always predicted the endowment at the bottom of the rankings. Yeah. But in this instance, it's the active managers must be really laughing because they're going to say, you should be stock picking. And I don't agree with that. I still think, that's a dangerous thing to do, not always, but it shouldn't be a no-brainer in either direction. But this is an important point here. So, I just want to spend a little bit of time on endowments now, because a lot of the time, endowments are sold to people who aren't at the maximum tax rate, and they say to themselves, well, I should just do this.
But it's also, the critical thing you're saying there is endowments are sold. And the broker comes and sits opposite you, the advisor, and sits opposite you and says, you need to start saving some money. Little Johnny is not getting any younger. And, their school fees are coming. So you must put it into an endowment. An endowment is a very good vehicle. What they don't tell you, it's a very good vehicle for us. You're paying an absolute blooming fortune, for investing in something fairly simple, I would think. You'd be better off putting your money into a tax-free savings account.
Yeah, true. I mean, I think that's one option, or just a straight unit trust or a straight exchange traded fund. Why I'm hesitating on the tax-free savings is just that, that might be your, kind of your long-term retirement planning, and now you've used up that money for education.
You put it in the child's name and say, I'm not paying for education. Here's your tax-free savings account. I've been putting money in there for 18 years. You can now go to university. Well, I want you to pay. Well, you can either have the car or you can have the education. You choose.
Choice. Yeah. Well, you know what the kids are going to do?
They're going to go to education. Of course they are.
Well, nowadays they're just going to say, I'll take the money because I don't need to drive anymore.
True. And I'll use it on Ubers. You could put it into an ordinary unit trust. Is there an argument under any circumstances if a financial advisor, broker says to you, you must buy an endowment?
Yes.
Is there an argument?
Yes.
What is that argument?
So a couple of things. One, it does always apply, I think, to the higher value investors. So people who are investing a lot of money who are at the maximum tax rate, and then especially those that have trusts, because trusts nowadays just get absolutely hammered by tax, in every angle. And in that instance, for example, if a trust, if they make a long-term investment in an endowment for a trust, I think that the tax benefits are significant. And the same for a private individual who is going to be at the maximum tax rate. However, I think you need to look at the costs of the endowments very carefully. So a lot of the time nowadays, if you look at a unit trust company, for example, they'll give you the endowment for free. They'll say to you, listen, if you're going to buy our unit trust, that's fine. What we'll do is we'll provide the endowment for free. So we're not trying to double our fees, but we know the lock-in. So I mean, what's the angle? Why is it too good to be true? Well, the too good to be true is
your money is locked in for at least 5 years. Yeah.
And yes, you can access the money, but the a unit trust company knows there's a fairly good chance you're going to leave it in for at least the 5-year period. And that's really what they want. Their kind of golden dream is, let's get investors, let's get them, to stay investors for a very long period of time, and we win. So we'll give you the endowment. In that instance, if you're only paying the unit trust cost, it starts to become a better deal.
And where then does the justification by the insurance company come to charge you massively for an endowment? If unit trust companies are prepared to give them away for nothing as an incentive for you to stay locked in for a longer period of time, how do the insurance companies justify the fees?
So I think there's two angles here. One, they will tell you that they make endowments available for very small amounts of money, and it's very expensive to create investment vehicles for smaller investors for small amounts of money, and they do need to charge these fees. I think it's a dying argument because there's platforms now like Easy Equities that will take your 50 rand a month and they won't charge you a huge amount of money. So I think that argument is busy dying. But the second point is you need to pay. I'm uncomfortable with the argument, but the other argument will be you need to pay for advice. And so for someone who can only afford, let's say, 100 Rand or 300 Rand a month, you might not be able to afford to get good advice. And then this is a way for you, if you're using an insurance agent who can give you advice, then you're getting the advice. And I'm really not saying for free, you really are paying for it, but you're going to be paying for it over the next 10 or 20 years by the insurance company's fees. Therefore, there's some kind of a trade-off now between getting advice now, paying for the advice over long periods of time alongside the investment. And I think there's a small merit to that argument, but it really makes me uncomfortable because a lot of the time what it's doing is gives the insurance agent big upfront, commissions on small amounts of money. The investors then don't get a lot of ongoing advice, and what happens is after year 3, year 5, year 7, they don't stay invested and they lose out anyway. So the costs don't get spread. So to me, the short answer is always be careful if you're going to be offered a product that's going to lock you in for a period of time. Number 2, if there are upfront fees, be really careful. And number 3, if you've got a trust, great. I think you probably do need an endowment if it's a long-term investment. Choose it from a unit trust company because that's free. I like free stuff around investments. To me is always good. Or if you are a high income tax paying investor, then there might be merit. So it would be wrong just to say they're all lousy, but fees are a critical point here. And I think that's the problem is
fees corrode your returns over 10, 20, 30 years.
Yeah. And then the last part is we've been choosing an index to be fair to the insurance company. Most of the time they're not going to put you in an index. They're going to put you in their fund manager products, and their fund manager products are often quite expensive, and recently, and I'm saying recently being 5 to 10 years, they've actually done pretty badly and properly underperformed the index. So just be careful there as well that, this isn't going to solve all your problems.
Warren Ingram, thank you. Personal financial advisor, executive director at Galileo Capital. The question this evening is money better off invested in the shares of endowment providers or in the endowments themselves? Based on the numbers crunched by Warren Ingram this evening, it has been a considerably better idea to buy the shares than put the money into the endowments, and there's nothing to suggest that will change anytime soon.